The supply of money doesn't need to be elastic, and Bitcoin is the best money. It's possible that a perfectly inelastic monetary supply may actually lead to unimaginable economic growth. Let's take a step back and think about what money and finance actually does. What's the purpose of banks, wealth managers, and index funds? Well, modern finance is just a bunch of middlemen. They exist to help you preserve and grow your wealth, but all banks, wealth managers, and index funds do is take money from you and give that money to someone else. And of course, they charge a fee for doing so. There's nothing inherently wrong with these marketplaces and middlemen in these marketplaces. There's only something wrong if this whole process of capital allocation could be done more efficiently. Logically, bad money increases the need for all of these middlemen. If your money loses value year after year, then a large portion of your wealth needs to be with these middlemen. You'd keep very little cash in your wallet, and most of your wealth would be at a bank or with a wealth manager or in an index fund. Opposingly, if you had good money, it reverses the need for these middlemen. If your money increases in value year after year, then a large portion of your wealth could actually just be holding the money without any middlemen. You'd have no need to hold wealth in a bank, hire a wealth manager, or buy an index fund. Your money would preserve and grow your purchasing power for you because the money has a fixed inelastic supply, and capitalism naturally leads to technology deflation. Keynesians would hear this and think it's terrible. They would argue that the world needs bad money, so someone will finance mortgages, corporations, and other businesses because we need these entities for growth. Keynesians want you to be forced to perpetually invest your money, even if you don't know what's the best asset to allocate to. But it's reasonable to understand why they have this perspective. All of our previous monetary tools have not been perfectly scarce, and they've also not been portable over the internet. This results in debt-based monetary systems naturally forming, since people can't easily save or settle payments in the base money itself. The market naturally saves in IOUs that earn interest and are more portable. Once this market for IOUs gets big enough, it becomes systemically important, and governments and central banks prevent their inevitable collapse. This perspective may have been right, but now that Bitcoin exists, it's wrong. As a society, our goal should be to allocate capital to the best capital allocators and to do so via a free open market with undistorted prices. If there was somehow a way to do this without middlemen, then the market could be much more efficient. My thought is it's possible that Bitcoin actually does this. When you buy and hold Bitcoin, that very act marginally increases the price of Bitcoin for all other Bitcoin holders. Now, existing Bitcoin holders have more wealth in their savings. In fact, if someone is buying Bitcoin, the price of Bitcoin will go up until at least one other existing holder of Bitcoin decides to sell Bitcoin to consume or invest. Because of Bitcoin's perfectly fixed supply, this system works well for automatically allocating capital to all other existing savers of Bitcoin without any leak. This idea historically fails with all previous inferior monetary tools because when you save gold, seashells, or dollars, there's only so much wealth that can be saved before society starts allocating resources to gold mining, seashell hunting, or dollar printing. Think the Federal Reserve or fiscal deficits. This obviously increases the supply of these monetary goods and also moves resources away from productive enterprises and towards the creation of money. Because of this, there's a market-enforced cap on how much wealth can be held in these inferior monetary assets. But this cap doesn't exist with Bitcoin. And even if the monetary supply leak from these inferior forms of money is small, it's still enough to force holders into more portable money substitutes like banks to earn yield. So as more people hold Bitcoin, capital, wealth, or the optionality to spend wealth doesn't get distributed to one bank, one index fund, or one wealth manager who then splits the wealth into a bunch of small pieces for companies to spend if they wish. The capital or wealth gets automatically distributed to everyone holding Bitcoin. Then everyone holding Bitcoin evaluates their investment opportunities with their increased purchasing power and potentially sees a good risk-adjusted opportunity to invest. This means holding Bitcoin actually allocates capital automatically to the individual who sees the best risk-adjusted opportunity to invest their Bitcoins in a productive business. And it does this without a middleman. In a way, holding Bitcoin in cold storage is what the financial system tried to create with index funds, wealth managers creating diversified portfolios, and banks. Buying and holding Bitcoin allocates capital to the other Bitcoin holders most likely to invest next. And the other Bitcoin holders most likely to invest next are the individuals that see the best risk-adjusted opportunity to invest. What's amazing is as everyone begins using Bitcoin as money, society effectively begins automatically allocating capital to the best investment opportunities without any unnecessary middlemen. And again, this has never been possible before with money that isn't perfectly scarce and isn't portable over the internet. Bitcoin has created a new economic reality where you need to question your original assumptions. If this thought process is true, then an economy that would naturally form on a Bitcoin standard will likely 100x total global wealth, and this increase in total global wealth will coincide with a higher investment hurdle rate, because all investments need to outperform Bitcoin on a risk-adjusted basis. This means 100x more individuals having the optionality to pursue only high alpha investments will lead to explosive economic growth. Let me know what you think about this. Is this not clear? Are there holes in the argument? Leave some feedback and share if you thought this was interesting. Thanks for watching, everyone, and see you next time.